kind of hold my nose last year and be risk on, despite kind of having fundamental problems with this market bubble. But the Fed was clearly signaling a dovish 2025. And my simplistic reduction of how markets work is when a central bank is dovish, markets tend to rise, and when a central bank is hawkish, they tend to retract. And last year at this time, it was fairly obvious from November all the way into December and January that Powell was throwing in the towel on rate hikes and going into cuts, which is precisely what happened in 2025. It wasn't in 2024. And the market, again, being Pavlovian, just the carrot dangling of a rate cut got markets galvanic and hopeful, and it was a tailwind, and we saw a pretty decent year in the S&P as expected. But again, rate cuts to me were a sign that despite not hitting target inflation and not beating the inflation, taming it, that rate cuts were a desperate move at the same time. So it was kind of bipolar, but it certainly was a tailwind for the markets. But rate cuts were also a tailwind for gold. And so obviously gold hit nominal highs in many currencies, including the US dollar. It's over 27%. In the Eurozone where I am, it's over 33%. In the Swiss franc, 36%. So obviously a very good year for gold. That wasn't just market genius. I wasn't alone in that. I certainly was bullish for both, which is ironic because usually I'm very cynical, and I still am cynical about markets, and we could talk about this year. But for gold, it's always simple because debt never changes, and there's a debt collapse driven by sovereign debt crisis, not just in the US, but globally. And gold doesn't rise because it's in a bull market. It rises because fiat money's in a bear market. And that certainly hasn't changed yet. And to your question now on 2025 on the markets, I'm less bullish. It is fascinating, by the way, that we have to spend so much time talking about a central bank to discuss markets, because technically, ideally, we should have natural supply and demand, free market discovery, fundamentals, balance sheets, price to book, price to earning, a basic Benjamin Graham Buffett analysis of markets. But what we're really talking about first is the central bank. And again, as in this year, Powell is still dovish, but moderately dovish. You know, he's talking about rate cuts, but throwing out the possibility of less rate cuts or even a potential rate hike. That is already a signal that the markets are a little curious or concerned. Again, it's not the only factor. The other thing that's really amazing after this year with the S&P, and again, the contrast of the market with the real economy is appalling. And we could talk about those recession indicators, but regardless of the Main Street economy, which is just a working poor disaster, in a lot of ways stressed by years of higher for longer, but regardless of the economy being poor, there are certain basic indicators that are gravity defiant for only so long. The Buffett indicator, S&P to GDP, and it's at all-time highs. And that's just the indicator itself at 204, 208. Those come in rare moments, and usually those peaks are followed by significant sell-offs. So the potential for gravity and mean reversion reasserting itself in the markets is more real this year than it was a year ago. The fact even that Buffett himself is so heavily into cash is a leading indicator of risk off too. That's different from last year. There's another indicator that I used to use, certainly when I was trading risk assets, is the S&P to currency in issue. And that's another ratio. You can find the charts. It's also nearing all-time highs. The other thing about this market that's changed dramatically and gotten worse since last year is the narrowness of the market. You know, in the 70s, I wasn't trading, but when I grew up, we had the Nifty 50, and that was considered kind of unique. Then we had the Magnificent Seven or the Fabulous Five, or now the Triumphant Trio. It just keeps getting more and more narrow. NVIDIA, again, not saying it's a bad company, overvalued company. Like I saw in the dot-com bubble, I saw companies like Lucid and Microsoft and Qualcomm, all good companies, Cisco, good companies, just grossly overvalued. And they took significant hits once the net income margins went down. You know, NVIDIA's market cap is equivalent to 12% of US GDP, or that the NASDAQ has a PE of 49. Now, the bulls would say, yeah, these narrow overvalued stocks, they have higher PEs, but the rest of the S&P 494 have PEs of 16 or less, or more fair valuation. But the problem is when a market is this narrowly led, when the big boys sink, all ships go down in a lower tide. They take them with them. So these things are very interesting. And again, it's not just a gold bug trying to be negative. I could be relatively agnostic on the markets. They will affect the gold price. But it's Jeremy Grantham, Paul Tudor Jones, Gundlach in the bond market are going more and more to cash because it's just starting to feel that this is getting to the point, again, can't be timed just on instinct, but it's starting to look frothy. And so all these combinations matter. And then the classics Benjamin Graham valuation still matters. Charlie McKay on the madness of crowds is starting to feel a little more maddening than even it did last year. Last year was so obvious because Powell was giving you a green light. Even the mostly forgotten Robert Farrell, that all markets mean revert. Unless, of course, the Fed decides to nationalize essentially the markets and produce liquidity. But it won't be until there's an uh-oh moment, and then the fire hoses and the bazooka and the QE comes out. For a long time, the Fed has been focusing on rates to manage. They only have two tools, right? Rate cuts and balance sheet. For now, they've been working with rates. Powell's kind of flip-flopping a little bit on that, or textually not being completely clear, which is typical of Powell. The only other option they have if things really hit the fan is QE. And I think at some point we'll see QE to the moon, but that's very hard to predict. But for those stock pickers out there, what I would look at when you look at the markets, look at the leading stocks driving the S&P and the NASDAQ, look at their net income margins. They're rising now. When they start to go flat, that's fine. When they actually start to go negative, that's when you can call close to a top. And even when they fall, it won't be in a straight line. But right now, there's still liquidity through the TGA, through the reverse repo. This is drying up. TGA has got about $650 billion, but there's always the opportunity to mouse click money out of thin air if Powell's compliant and supportive, or if he lets markets have natural price discovery. It'll be very interesting, but no matter what, long answer to a short question, not nearly as bullish as I was last year on the markets. The bond market is the thing. And really, what is the bond market? It's about credit. Credit's about debt. And when you understand that, and it doesn't take a lot of thought, once you understand the fundamentals of it, it really helps you understand all other asset classes and sectors and areas and topics, because debt is the key stone from the ripple effect on everything we could talk about, whether it's currencies, whether it's the bond market, whether it's Fed policy, whether it's the precious metals market, whether it's currency risk. It all comes from this debt collapse. This debt collapse is driven by sovereign debt that's gone too far. Clearly in the U.S. at $36.2 trillion and racing, that's a sovereign debt problem. The U.S. is the home of the world reserve currency and the 10-year treasury. So the U.S. sovereign debt problem is a critical problem, but you obviously have the same problem in Europe. You have the same problem in Canada. You have the same problem in many countries. Ironically, not in Russia as much as in China or other countries. Russia has much less debt, ironically. But when you understand that, okay, there's a sovereign debt crisis, they're over their skis in debt, and that debt isn't sustainable. And again, $36 trillion is appalling. It doesn't even include the $200 trillion unfunded liabilities. And if productivity, GDP, or tax receipts aren't there, well, then you have a problem. You have a delta, you have a gap. And typically, central banks fill that gap either directly through QE or taking from the Treasury General Account or exploiting the reverse repo markets or other mechanisms of indirect QE. But that is running dry in the reverse repo, and the TGA only has so much, as I said. And the other thing is you can issue more debt and float it. The problem is, for a number of reasons, less and less buyers for those Treasury auctions exist for two key reasons. One, again, whether you agree with the BRICS narrative or not, there is a de-dollarization process. It's not overnight. It's not going to destroy the dollar. It's not going to replace the dollar. But that process is taking demand away from the dollar, and there's less demand for U.S. Treasuries. So foreigners are buying less of them. China and Japan in particular are key. Traditionally, our two number one buyers of U.S. Treasuries are net sellers this year. So the weaponization, and not just the weaponization that's made other nations, particularly the BRICS nations, less interested in our IOU, our U.S. 10-year. The fact that our country's in so much debt makes us a less appealing IOU in terms of real or inflation-adjusted returns for foreign investors too. So these factors all mean there's less demand for that bond market. So when there's less demand, bond prices go down. And people need to understand this isn't rocket science. When bond prices go down, yields go up. And rising yields are like shark fins to the economy, because rising yields are the real interest rates, not the Fed funds rate. It's not what the Fed or Powell tells you. It's what the bond market tells you. When the yield on the 10-year of these bonds start rising, those are like shark fins. And they scare away a lot of things. They hurt the S&P because the S&P is driven by companies that borrow, and rising yields are the price of debt, the cost of borrowing. So when they go higher, that slows things down. Bond prices go down. When bond prices are under threat, when the yields are rising, stocks tend to go down. Obviously, the rising cost of debt hurts households and businesses and individuals. It hurts mortgage. It hurts real estate. So, mortgage applications are down 63% this year in the U.S. That's back to 1995 levels. So again, they're all connected from this topic of debt, the purchasing of that debt, lack of demand for that debt, rising yields are the sharks that are chewing on the hope of all these different sectors. That's not sensational. That's actually happening now. And that'll be a big challenge for any Fed official Will or any incoming president to try and control those yields. And if they can't control them through GDP, taxes, treasury auctions, foreign demand, all of which are not as strong as they were years ago, they're going to have to create liquidity or synthetic liquidity, and that is currency debasing. And of course, that ties to gold too. When you talk about debt, you're really hitting every major area, sector, or talking point, and it makes it fairly easy to track once you understand how terrifying rising yields are to just about everything in the economy except the US dollar, because rising yields help the dollar. And then the only real strong thing is the dollar, everything else goes down. But what's interesting about gold we can talk about is despite a rising DXY or a rising dollar, gold is just decoupled, it's still rising. So that's an interesting thing as well. Trump has a few key themes: the tariffs, this Department of Government efficiency, which again, I'll just say the short answer is those are inflationary policies. And at the top of the pyramid of that discussion is the key to him succeeding is to get debt to GDP down. And the problem is with debt, whether it's him or I've said Santa Claus or Papa Smurf, that's going to be hard for anyone unless he cuts severely into entitlements and military spending, because entitlements, military spending, and interest on debt are 75% of the budget. There's not a lot of room to play. That's very politically difficult to do. The Department of Government efficiency and the pink slipping of 75% of the fat and bureaucracy of DC is wonderfully optics. It's very good. There's a lot of waste in DC bureaucracy, just like there's in any bureaucracy, but 25% of GDP comes from government. So if you just pink slip the Department of Education and a lot of waste on the Beltway in DC, that has great optics politically. It may even be necessary, but you don't want to do that with a strong dollar, because you're going to be letting a lot of people out. There's going to be a decline in GDP just by the nature of government spending. And even with Elon Musk and Vivek doing that, the question is, does he even have the mandate for that? He has the mandate to raise tariffs through executive order. DC is very embedded, very full of political, I hate to say the word prostitutes. They'll do whatever their lobbyists tell them. They'll do what their embedded structure is. So they will sacrifice whatever values for the country they have for the good of their lobbyists. But again, to do the cutting of the fat in DC, I understand that will have an effect on GDP though. And necessarily when you lay off levy people, when you have a strong dollar, you put them into a levered economy, 70% of GDP comes from the consumer. If you've got less consumer strength, that actually makes GDP worse. So he's battling a lot of moving parts. I'm not saying he'll fail, but it is certainly going to be important to do that with a weaker dollar. The other big topic, of course, is tariffs. On the positive side, clearly, for example, I live in France. The French have a 25% tariff on American wines. I live in Bordeaux. You can't find American wine in a French restaurant. It's a simple example. So you can say heroically, Trump is saying we've got to make changes. There's imbalances in trade. We got to play hardball, and this is how we're going to do it. That's the positive side. The extremes, 25% tariff to Canada, 100% to BRICS, to trade outside that. These are inflation things. And I think despite all the good intentions to reorganize fair trade, which I understand, one small example of how this, history doesn't repeat itself, but it rhymes. We did try tariffs in 1930 under Hoover. It was called the Smoot-Hawley Tariff Act. Blow the dust off the history. Again, it's not exactly the same situation, but it's close. And the long and short of it was when they did those tariffs, it was a disaster. First of all, Hoover didn't get reelected. Both Smoot and Hawley, the senators that it was named after, didn't get their seats back. It led to a massive amount of retaliation and export declines from us, the tariff the wall maker. There's going to be reaction, tit for tat. And the question is, who can hold their breath the longest on this? How much instability will it create? How much inflation will it create? How much stress will it put on our economy? What the pro-Trump camp would say is, yeah, those are possible risks, but the only way to reshore manufacturing is frankly to punish American CIOs and companies offshore in Asia, in South America, getting cheaper labor, putting a huge pain on their products coming in. So if they really want to have an American buyer, an American camp, an American demand, they better bring their manufacturing back to avoid those tariffs. And I can understand the optics of that. So again, there's a lot of if but going on. Trump will definitely do what he says. Again, whether that's efficient, whether everyone cooperates, whether the West of the world cooperates, whether GDP cooperates. But the bottom line is, unless he gets the debt to GDP ratio down, he can't succeed, because historically, when debt to GDP crosses the Rubicon of 100%, we're at 125. I mean, this is going back to classic economics, certainly to David Hume, growth stalls by 1/3. And you need to get growth, you need to get productivity in the GDP. Deregulation that Trump is going to offer, that's helpful. But again, that will not be enough. He's going to have to really cut the debt side. And the spending cuts that the Doge camp will create isn't nearly enough. Frankly, firing a lot of people in DC, it's a lot of jobs. He can save $25 billion in interest expenses by cutting interest rates by 25 bips. So it'd be actually easier if the Fed cooperates with Trump. And that's a whole other issue too. Will the Fed be accommodative to Trump? When if he is what he wants, he's king of debt, as he says, he's going to need rates cut and money printed to inflate his way out of this debt crisis. We'll see.